What is the primary issue with mechanical 0 DTE SPX spreads, whether it's vertical spreads, condors, whatever the case is, they don't work. And I want to explain to you exactly why this is the case. So let's get over and jump right in. The first thing, what's the want? Why do people want to trade this strategy? Well, it's pretty simple. We all want something that is super simple, that has an edge, that we don't have to think a lot about, AKA the mechanical aspect to it. What's the problem with this? Well, the reality doesn't line up with that want, meaning 0 DTE SPX, they're high probability trades. It means that they are poor at giving you effective feedback as to how they're doing. So when you have a trade on that is working and you get a ton of winning trades, typically smaller wins, you get a lot of bad feedback because you're saying, oh, this all works great. I'm winning so frequently. The issue is market conditions that are deemed as quote unquote rare, they happen way more frequently than people price into the market. This is why you will constantly hear the markets have these big old fat tails. A fat tail, when we look at a log normal distribution, which the markets aren't, but we use that as a proxy. Whereas a normal distribution, if we chart it out, it might look something like this, where we have these tails that are really low. And that low in the tail down here, so this gap in here, this is essentially a representation of how frequently it happens. So when we're talking about fat tails, they actually look more like this. And what this means is this space on these tails, improbable events, is actually bigger. And it means that it happens more frequently, which is really important for people to understand, especially when you're attempting to trade something like this. So I want to walk you through a couple back tests that I did real quick. There's not a lot of optimization here, but then I want to show you, more importantly, a visual representation of why this strategy works perfectly fine in certain market conditions, but not so fine in other market conditions. So first off, let's see the issue with the structure of the trade, which I've talked about this before. I have a video talking specifically about it. I will link it to the video description below. But essentially, when we trade spreads, meaning again, verticals or condors, we're fighting against ourselves. And it's just so that we don't have, it's a hedge. That's why we're putting that spread on. And the reason why we're fighting against ourselves is when we are trading this strategy, we are attempting to capture the variance risk premium, the propensity for implied volatility to be higher than realized volatility. So when we're doing that, we're selling premium to attempt to capitalize on that. But when you're buying premium, meaning the wings on both sides, you're buying the very thing that we think is expensive and we're trying to sell it. So you're giving away edge there. And it's super important to note that. And I will show you exactly why. I have two back tests here. These are from my friends over at Options Omega. So I have a link to them in the video description below. If you're looking for options backtesting software, I do use them. They're pretty good. And I want to show you something. So on the left-hand side, we have an iron condor. This is really the general disposition of the trade for those that are wondering, what are the pieces that I'm looking at? And it's essentially just saying we have a short 16 delta and a long 10 delta on both the call and put side. So in this, we're looking at a few things, but primarily notice how over the past 2 years, that's the time frame for the strategy, it's losing. And the other thing I want you to notice, this is essentially taking it 100% profit and a 300% stop loss. That stop loss is really common for these trades, and it's a slow killer to them. So there's tons of ways you can optimize this. This is not a video about optimizing the strategy. There are ways to make this look better, and I intend to show you that in future videos. But I want to highlight the primary problems with it, this general structure for this type of trade, specifically using verticals or condors to take advantage of the variance risk premium. So I'm focusing on that here. Now on the right-hand side, it's essentially the same exact thing, but I zoomed this out. And what I mean by that is instead of this being a 16 delta entry on the short and then a 10 delta entry on the long, it's a 10 delta and a 5 delta. So even further out of the money. And when you run this, it actually is profitable until you add commissions. And I have it at just 65 cents a leg, which is common for a lot of people. You can have it slightly lower than that if you negotiate with your broker. But the point being, this was slightly profitable until you add fees. That's another issue when we're trading verticals or condors. We're adding legs, we're adding expenses. So let's talk about then an alternative. If you like these strategies, and the way that I tend to trade them is using short strangles or short straddles. And you can use the very same stop if you're so inclined. And again, we need to be a little more calculated in our targeting of implied volatility versus and historic volatility, which I'll show you in a second. But anyways, these are the same exact time frames. And instead of using verticals or iron condors, both of those were iron condors, this is using just short strangles. And this is at a 15 delta on the left-hand side, and on the right-hand side, it's a 10 delta. And we're taking profit at 100%, meaning we're essentially riding into expiration. Stop loss is at that same 300%. Notice the difference already. These both already have fees included as well. And notice what you see. We actually have a profitable trade both in 2020, and when we look at 2021 as well, we walked out at a slight profit, and 2022. Let me move my face up out the way so that you can see this one over here. And it's a similar story. When you move out to the 10 delta, you're actually slightly more profitable. And except in 2021, you would have walked out at essentially a break even, but you made more money in 2020 and specifically in 2022 for sure, moving a little further out of the money. So right out of the gate, notice this strategy did $18.8 thousand return. This did $23.6 thousand return. Same time frame. The only difference is this was moved 5 deltas further out. This is why you can't just set it and forget it. You can't just decide I'm going to do X and perpetually do that in all market conditions. So when we're talking about setting up these mechanical strategies, that's fine. If you want to be rules-based, protocols-based, totally fine. You need to make sure that there's time for you to reevaluate the details and the output of your strategy against what you're attempting to accomplish and optimize frequently. If you don't do that, you're going to get chewed up. There was a ton of people that were trading the vertical version of this that just got crushed over the last couple of years. And I want to show you why they're getting crushed. And it's very simple. If we take a look, these look really small, and that's on purpose. This is a 10-year daily of SPX. And I just want you to look at the size of the candles. That's it. Just look at the size of the candles here. We can see that on this random one that I'm highlighting, the high is 1843 and the low is 1815. So just call it, 30 points, something like that, 28 points. So now as I move back, again, this is going back into 2013. There's 2014, looks very similar. We cruise into 2015, and it's pretty similar until the tail half of the year. Notice that we start getting some bigger candles. This is the problem with having a set it and forget it. I do the same thing always perpetually, no matter what, and not adjusting. As soon as this starts to happen, we're going to start seeing realized volatility over and exceeding implied volatility. This strategy won't perform well in those circumstances. So let me fast forward us. Notice the size of the candles, essentially starting from the COVID drop compared to what you were just looking at. Take a look at the size of all of these candles now. What this means is, and this is where it's really extreme. What this means is we are seeing much larger intraday moves. You're seeing more periods where realized volatility, like right here, is exceeding implied volatility. This strategy will not do well in those circumstances. You need to have an alternative approach that you're making sure to integrate that part in your analysis. Otherwise, if you just think, oh, I'm just going to let the numbers play out, you are going to lose. You are going to get ran over. So in the next video, I want to walk you through some different ways you can conceptualize how to optimize this strategy so that as you receive data, you receive information from the performance of the strategy, you can then tweak it. You can say, hey, I'm noticing that the market is opening up. I'm getting bigger intraday moves. I need to make an adjustment. What adjustment makes sense? We're going to talk about that next time. So if you made it to the end, like, subscribe, be an outlier. See y'all later.